Can't hear you. Your mouse, what's it called? Your
Okay.
mic is muted. Yes.
Okay. Good day. Good morning, everyone. Today is the 13th of August, 2022. Yeah, and today we'll be discussing on fair value requirements as part of the requirement under IFRS 3, which says that the acquisition method will require us to identify the acquired asset and liabilities of the investee company or of the acquired entity. And on this premise, we will now be required to fair value all of those assets acquired and liability assumed. So we will be looking at chapter 7 of our material, talking about the fair value implication. Acquisition and subsequent to acquisition, what will be the post-acquisition effect of such fair value adjustment that may have been done as at the point of acquisition. Okay, and therefore we'll move to chapter 7 of our material, where we'll be having extensive discussion of all of this. Okay, now let me enlarge this, and I want us to have a better view of what will be required of us at this level. Okay, in this chapter, which is chapter 7 of the material, what we'll be discussing extensively will border on the requirement of IFRS 3, which will require us to fair value both the consideration offered at acquisition and also the net asset of the subsidiary acquired at acquisition. And also we'll see how we treat the effect of acquisition fair value measurement, okay? And also how it may affect the recognition and the amount of goodwill or gain arising from a bargain purchase transaction. And we'll close it out with the post-acquisition effect of what we have done as at the date of acquisition. All of these are what we are going to look at today. In addition, we also look at what we promised to look at in today's section, which is with respect to what role does preferential capital play in the capital structure of an acquired business, and how do we consolidate the interest of the parent in the preferential capital of an acquired entity, or where the acquired entity has a preferential, but the parent do not have any interest in it. What will be the impact on consolidation? All of these are what we're going to look at in today's session. And to look at that, I want someone to just have a feeler to what we'll be discussing also today. Now, who will volunteer to make an expression of this? And from there, I'll be able to elaborate much more on the requirement and of the effect. Thank you. Any volunteer? Who will volunteer to take this up? Okay, who doesn't have a background noise there? I think someone has a background noise. Janet? Okay, who else? Since Janet, is Esther there or Shadi? Since everybody's saying they have background noise. Okay, Esther, are you there?
Yes, I'm here.
Okay, can you take it up? Thank you.
Okay. Fair value and business combination. Business and economy minutes. Okay, IFRS 3 reverse requires the cost of investment and the identifiable assets and liabilities, net assets of the subsidiary be measured at fair value option, fair value upon acquisition of the acquiree or subsidiary. It has been observed over time that the book value, which is the carrying amount of the subsidiary's net asset at acquisition, do vary from fair value of the identifiable assets and liabilities as at acquisition date. The rationale for the net asset of the subsidiary to be valued, remeasured at fair value at the date of acquisition is to ensure current price, including unrealized earnings, that is, profits or losses, are reflected in the value of the net asset at the date of acquisition, and to prevent destruction of earnings per share in periods subsequent to or after the acquisition. This makes it a necessity to revalue the identifiable assets and liabilities of the subsidiary prior to consolidation as at the date of acquisition. It is equally necessary to note that the parent asset and liability remain unchanged at book value, which is the carrying amount as presented in its separate financial statement, and are not required to be fair valued at acquisition date. While it is only the subsidiary position, assets and liabilities that are to be fair valued and adjusted for the purpose of presenting consolidated accounts. IFRS revised sets out general principles for arriving at fair value of subsidiary identifiable assets and liabilities. The parent should recognize the subsidiaries' identifiable assets, liability, and contingent liabilities at the acquisition date if the following criteria exist. A, in the case of an asset other than an intangible asset, it is probable that an associated future economic benefit will flow to the acquirer and its fair value can be measured reliably. B, in the case of a liability other than contingent liability, it is probable that an outflow of resources and bundling economic benefit will be required to settle obligations, and its fair value can be measured reliably. C, in case of an intangible asset or a contingent liability, its fair value can be measured reliably. The technical note here is the subsidiaries identifiable asset and liability might
Thank you, ma.
include
Thank you
asset and
for
liability
that.
not previously recognized in the subsidiary's financial statement. The fair value adjustment carried out upon acquisition of the subsidiary is considered as an adjustment to pre-acquisition reserve, which implies that prior to acquisition, the fair the value inherent in the subsidiary and as surfaced and recaptured on the acquisition should be considered in determining the amount of goodwill on acquisition or gain from a bargain purchase transaction. It is worthy to note that fair value adjustment carried out subsequent to acquisition cannot be retrospectively applied or considered as an adjustment to pre-acquisition reserve. As such, fair value adjustment was subsequent to economic and market effects, that is, and fundamentals of the subsidiary since acquisition. And in such case, it is considered an adjustment to post-acquisition reserve, which should be included in the consolidated reserve. In calculating goodwill arising on consideration or gain from a bargain purchase, the net asset of the subsidiary should be restated at its fair value. And there exist two possible ways of achieving this. A, the subsidiary might be incorporated unnecessary for fair value adjustment in its financial statement, and its accounting policy may support measurement at fair value, such as financial instruments, biological assets, investment properties, some components of property, plants, and equipment, etc. In this case, you may consolidate directly as the assets and liability have been restated at fair value. and pre-acquisition adjustments have been effected. Is that all? Okay, the fair value adjustment may be required. The fair value adjustment may be required as a consolidation adjustment without being incorporated in the subsidiary's financial statement. In this scenario, we need to make unnecessary adjustments at the point of consolidation, that is upon preparing the group accounts. An accounting treatment of fair value in a business combination. The parent should recognize separately as the acquisition date fair value the acquirers or subsidiaries identifiable assets, liability and contingent liability only if they satisfy the following criteria as the date. I, for an asset other than intangible assets, it is probable that an associated future economic benefit will flow to the acquirer and its fair value can be measured reliably. 2, for a liability other than a contingent liability, it is probable that an outflow of resources and bundling economic benefit will be acquired to settle the obligation and its fair value can be measured reliably. 3, in the case of an intangible asset or a contingent liability, its fair value can be measured reliably. Identifiable assets and liability recognized in the account are those of the acquired entity that existed at the acquisition date. The following specifically do not meet the criteria listed above and therefore must be dealt with at post-acquisition item. Changes resulting from the acquirer's or parent's intention of future action. 2, changes resulting from post-acquisition events. 3, provision for future operating losses or reorganizational costs incurred as a result of the acquisition. Restructuring and future losses. An acquirer should not recognize liability for future losses or other costs expected to be incurred as a result of the business combination. IFRS 3 explained that a plan to restructure a subsidiary following the acquisition is not a present obligation of the acquiree at the acquisition date, neither does it meet the definition of a contingent liability. Therefore, an acquirer should not recognize the liability for such a restructuring plan as part of allocating the cost of the combination unless the subsidiary was already committed to the plan before the acquisition. This prevents creative accounting. An acquirer cannot set up a provision for restructuring or future losses of the subsidiary and then realize this to the profits, this to the profit or loss in subsequent period in order to reduce losses or smooth profits. Intangible assets. The acquirer may have intangible assets such as development expenditure. This can be recognized separately from goodwill only if they are identifiable. An intangible asset is identifiable only if it's A, is separate, that is capable of being separated or divided from the entity and sold, transferred or exchanged, either individually or together with a related contract, assets or liability. Or B, arises from contractual or other legal rights. The determination of fair value upon acquisition of a subsidiary. IFRS 3 revised requires that the identifiable asset, liability, and contingent liabilities acquired, which will be recognized, should be those of the acquiree, which is a subsidiary, that existed at the date of acquisition. Liability that should be recognized should be assumed, that is existing and absorbed upon acquisition, and not those resulting from the acquirer's parent's intention or action. This implies that liabilities for terminating or reducing the activities of the acquiree subsidiary should only be recognized where the acquiree subsidiary has at the acquisition date an existing liability for restructuring recognized in accordance with IAS 37 provisions, contingent liability, and contingent assets. Furthermore, liabilities should not be recognized for future losses or other costs expected to be incurred as a result of the acquisition where they relate to the acquirer or acquiree. So what is fair value? IFRS 13 defines what a fair value is and also expatiates on the sources of obtaining fair value vis-a-vis the hierarchy of fair value measurements. Fair value, the price that will be received to sell an asset or pay to transfer a liability in an orderly transactions between market participants at the measurement date. IFRS 13 provides for reaching guidance on how the fair value of asset and liability should be ascertained. This standard requires that the following are considered in determining fair value. A, the assets or liabilities being measured. B, the principal market, that is where the most activity takes place or where there is no principal market, the most advantageous market, that is in which the best price could be achieved, in which an orderly transaction will take place for asset or liability. The highest and best three, C, the highest and best use of the asset or liability, and whether it is used on a standalone basis or in a conjunction with other assets or liability. D, assumptions that market participants will use when pricing the asset or liability. IFRS 13 provides a hierarchy of inputs for arriving at fair value. Is that all, sir? Okay. Fair value, IFRS 13, fair value hierarchy. This is level 1, level 2, level 3. Level 1, quoted price in active market for identifiable assets that the entity can assess at the measurement date. Level 2, inputs other than quoted price that are directly or indirectly observed for the asset. Then level 3, unobservable inputs for the asset. Technical notes, it requires that level 1 input is used where possible. We are to consider the above identified scenario with simple illustration as shown below. Scenario 1, the fair value of the identifiable asset and liability of the subsidiary have been recognized upon acquisition in the financial statements of the subsidiary as stated below. Illustration 1, Pali PLC acquired 80% of the equity share capital of Suzy PLC on the reporting date 31st December 2015. At the date of acquisition, the carrying amount, which is book value of Suzy PLC plant, was 130 million naira, whereas the fair value of other assets and liability equal the carrying amount of acquisition. The fair value has already been recognized in the financial statement of the subsidiary, as shown with the fair value of 150 million. The statement of financial position of the two companies on this day stood as follows. Statement of financial position on 23rd December 2015. Pali and Suzy. Plants for Pali 300, Suzy 150. Investment in Suzy PLC is 200. Current assets for Pali. Share capital and reserve. Equity share capital at 1 naira per share. Pali 400, Suzy 120. Reserve retained earnings 140 for Pali, 60 for Suzy. Revaluation reserve. Pali 0, Suzy 20. Then current liability for Pali 80, Suzy 20. Assuming the prevailing market price of Suzy share prior to the date of acquisition is 2 naira per share. Based on information.
Now, you now compare it with this. You read the second one, and I will explain the difference along with the explanation that I'm going to give to the entire discussion. Can you read the scenario B and stop at this assumption also? Just read from here to here. Okay?
All right, sir. So scenario B, the fair value of the identifiable asset and liability of the subsidiary have not been recognized upon acquisition in the financial statements of the subsidiary as stated below. Illustration 2, Pali PLC acquired 80% of the equity share capital of Suzy PLC on the reporting date 31st December 2015. At the date of acquisition, the fair value of SUSE PLC plants was 150 million, whereas the carrying amount, which is the book value of other assets and liability, equal the fair value upon acquisition. The statement of financial position of the two companies on this day stood as follows. Statement of financial position as of 31st December 2015, Pali and SUSE, plants 300 for Pali, SUSE 130. Investment in SUSE PLC 200, current assets for Pali 120, SUSE 70. Share capital and reserve. Equity share capital at ₦1 per share for Pali 400, SUSE 120. Retained earnings for Pali 140, SUSE 60. The current liability for Pali 80 and SUSE 20. Assuming the prevailing market price of SUSE shares prior to the date of acquisition is ₦2 per share. Thank you, sir.
Okay, thank you very much. Now I'm going to share my notes with you guys and let us discuss extensively on this. Now, what is the requirement of IFRS 3? As regards fair value at acquisition date. That's a question mark. Okay, the requirement is that as part of this process or step that is required based on the acquisition method, the acquirer is required to measure all identifiable assets acquired and liabilities assumed in the acquired business. And remember, we've talked about fair value. At this point, even from the video we watched before starting the session, we approximate fair value at this early stage to market price, which is the level 1 hierarchy. We are going to discuss much more about fair value, IFRS 13, when we get to financial instruments, level 1. For all of our discussion in business combination, we will assume that the acquired business is a quoted company, thereby we have access to its active principal market where we can obtain the relevant market price, including that the subsidiary we can easily fair value using various metrics and mechanics to identify the fair value of individual assets and liabilities. Now, why are we doing this? We are doing this in order to ensure that the amount of goodwill Sorry, the network went down. I believe you can hear me better now. Now, as I was saying, when the assets, the raw land was acquired, it was acquired for 100 million naira. And that was 5 years ago. And the accounting policy of the entity, the acquired business, was cost model based on IAS 16. And today, in the balance sheet of the acquired entity, the asset is still reflecting 100 million. And we are aware that the current cost of such a land or its rateable value today, based on probably inflation, price levels, development, and some other things, is going for 140 million naira. The question then is, that 100 million does not reflect the fair value, which is part of the consideration that the buyer may have offered based on the offering price by the seller, which is the owner of the acquired entity prior to acquisition. And in that case, it then means that what you have paid for in excess, which you call excess purchase price, may not be only attributable to goodwill. Most times, part of it, if not all, may be attributed to the fact that there is to reflect the current prices of what you have acquired as an asset or as a liability. And in that light, we need to compulsorily carry out this fair value measurement. And the question is, if we carry out fair value measurement, there are two sides to a coin, which means there are two things possible. The fair value might be higher than the carrying amount of the asset or liability. And likewise, the fair value might be lower. It depends on market condition and all other conditions. Now, the question then is, how do we treat it? Whether it's a fair value adjustment that is higher or lower will be treated as an adjustment against reserve as an acquisition date, which means will be treated as an adjustment to pre-acquisition reserve. Okay. Now, also there's a possibility that we carry out fair value measurement and the value is not materially different from the carrying amount. In that case, adjustment will not be required. It's only when there's a material difference. For example, if you fair value and the fair value is 1,000,005 naira, whereas the carrying amount is 1 million, the 5 naira difference will not be material enough to have influence or materially change or influence the decision that users of financial reports will take In that light, therefore, such adjustment will not be required. But any adjustments that is required is considered material difference between the fair value of asset and liabilities against the carrying amount of same asset and liabilities. Now, once we have that, we adjust it against individual asset and liabilities and the corresponding entry in part, the pre-acquisition reserve. Now, typically, if an asset is fair valued upward, it then means that you've had a gain from that asset, which constitutes an income. In that case, it's going to increase your reserve, which is pre-acquisition reserve, and also increase your assets. Conversely, if the fair value of the asset is lower than the carrying amount, it then means that you have to reduce the value of the assets, and likewise, it results into a loss, which is considered as an expense and is a reduction against the pre-acquisition reserve. If you also look at it from the liability perspective, if the liability fair value is higher than the carrying amount of what it was as at acquisition date, it then considers that the liability will increase in value, and that creates an expense which reduces our pre-acquisition reserve. And conversely also, if the fair value of liability reduce below what the carrying amount is, it represents a gain arising from such a reduction in liability, and that will increase our pre-acquisition reserve. And we need to take understanding of this. And therefore, we'll now see how this impacts the amount of goodwill that may have been recognized as at the point of acquisition. Now, before we go into an illustration that depicts this, I want somebody to more or less ask questions or request for clarification or make one or two contributions when necessary. The floor is open.
Okay, good morning, sir.
Yeah, good morning.
Okay, concerning the last statement you just made, you said if the liability is measured and is lower than as at when before the acquisition, you said it is going to increase. I didn't get that explanation clearly.
Okay. Let me put a diagram to it.
Okay, sir.
What I've said is this. Let me start with an asset. Scenario 1, scenario 2, where the fair value, let's say it's 100, and the carrying amount, let's say it's 90. The difference is 10, and which means the fair value is higher than the carrying amount. This constitutes an income, which will require an increase to the assets and also an increase to pre-acquisition profit or reserve. What if the fair value is 100, but the carrying amount is 110? What that depicts is that there's a reduction in the fair value, which we recognized as an expense or a loss. I remember a loss is an expense, which then means that what happened? An expense reduces your profit, which is your pre-acquisition reserve, and reduces also your assets. Now, if it's a liability, scenario 3 and scenario 4. If the fair value of liabilities is 100, but the carrying amount is 90, this is an increase in liability by 10, and an increase in liability, if you go back to our conceptual framework, our discussion then, we said an increase in liability that does not necessarily bring about contribution or distribution will be treated as an expense, and therefore this will reduce my profit, which invariably affect my pre-acquisition reserve and increase my liability. And conversely, if the fair value is still 100, but the carrying amount was 110, this brings about a decrease in the fair value measurement of the liability and a decrease in liability without necessarily settling any obligation, but based on measurements, adjustment, or movement, will constitute a reduction in liability and will constitute an income, which increases your profit, and invariably here is pre-acquisition profit or reserve.
It's clear, sir.
Is that clear?
Yes, sir. Thank you, sir.
Yeah. Any other question or contribution?
Hello, sir.
Yes, sir.
Hello. Actually, my question is in respect of the material, sir. I mean the material. I actually want to confirm the time we are likely going to get it, sir, so that we can just go.
Some have gotten it. You didn't.
Oh,
we agreed that you have to call to more or less give or agree modalities of getting it. For example, Madam Janet and Mr. Ademi has gotten this, and I think Esther will likely get us today. Again, I continue to say that you need to reach out so that we can know how you get it.
Okay, sir.
For example, you have not reached out, your location is not known, and if not, therefore, and it's not a soft copy, it's a hard copy, therefore we need to agree on that.
Okay, sir. Okay, sir. Thank you, sir.
Okay. Okay, now let's continue. Now let's demonstrate our understanding of how we effect these adjustments and how this impacts the group account. Now you've read two questions, and I'm going to put the questions side by side here. And I believe you can see the two on the same side. Now, I believe you can see the two questions. Now, I'll explain what it is. Now, the explanation is based on what has been read earlier. Now, if you look at this question, these two questions are the same, illustration 10.
We are not seeing the question, sir.
Okay, let me switch. Yeah, sorry. Now I'll switch. Now, illustration 10 and 11 are the same question. But the difference is that in illustration 10, the accounting policy of the company with respect to plant, which is an item of property, plant, and equipment, more or less is revaluation method. And as a result of that, the fair value adjustment also is reflected directly in the financial statement of the subsidiary. And that's why you can see that there's a revaluation reserve recognized, because the carrying amount before was 130, before it was measured at fair value of 150. But because the subsidiary's accounting policy is also revaluation method for PPE, you find out that this 150 has been reflected, thereby recognizing a revaluation surplus of 20. But when you look at the second illustration, for example, this has stated that there was recognition of that fair value in the subsidiary's account. But this scenario is saying that no, the accounting policy of the subsidiary in this case is more or less cost model. And as a result of that, any fair value adjustment we do or carry out as an acquisition has no effect directly on the financial statement of the subsidiary. Rather, it is just an adjustment we are doing as a parent from the group perspective, which means you see that the asset is still carried at that 130, even though it has been fair value at 150. the adjustment of 20 will just be tracked by the group accountant outside the financial statement of the subsidiary, which means it does not directly impact the financial statement of subsidiary, but it is something that you do as an adjustment on the financial statement of subsidiary before you consolidate. And we are going to see that as we move on. Okay, now let us first of all probably play with illustration 10, and we elaborate more on illustration 11 and make comparison of it. Now, in this case, let us look at it. And can somebody read again illustration 10, starting from scenario A, and from there, we'll more or less solve the problem using our Excel model. And we'll also now move to illustration 11. Over to you guys.
Scenario A. The fair value of the identifiable assets and liability of the subsidiary have been recognized upon acquisition in the financial statement of the subsidiary as stated below. Pali PLC acquired 80% of equity share capital of Suzy PLC on the reporting date 31st December 2015. At the date of acquisition, the carrying amount book value of Suzy PLC plan was 130 million. Whereas the fair value of other assets and liabilities equal to the carrying amount upon acquisition. The fair value has already been recognized in the financial statement of the subsidiary as shown with the value of 150 million. The statement of financial position of the two companies on the date is as follows. Statement of financial position as at December 31st, 2015. Pali, Suzy, million, plant 300, 150 respectively. Investment in Suzy PLC 200, current asset 120, 70, total of assets 620, 220, share capital and reserves, equity share capital £1 per share, 400 Pali, 120 Suzy, equity share capital at reserve retained earnings 140.60, revaluation reserve 20, current liabilities 80.20, total share capital and liabilities 620, 220. Assuming the prevailing market price of Suzy share prior to the date of acquisition is £2 per share required. Prepare the consolidated financial statement position as at 31st December 2015. Assuming non-controlling interest is measured at acquisition at the proportionate share of the subsidiary, identifiable net assets and liability. Non-controlling interest is measured at acquisition at fair value of equity instrument of the subsidiary. That's all.
Okay, thank you. Now let us switch to our model and try to provide solution to it the way it is. Now the question is shown here. And our parents, which is Pali, has 80% stake here. And before, we've modeled it. And once you say it's 80%, it gives NCI 20%. And once you say it is 90%, it gives NCI 10%. Okay, that's what you do in practice. You model your things by way of creating a template. And that makes it much more easier. Okay, therefore, what do? We also look for reserve. Now, if you check, the reporting date reserve is what? From the question in the balance sheet, the retained earnings is 60. And again, fortunately here, we acquire as at that reporting date also, which means our pre-acquisition is also 60. What does that give us? Implication that there was no post-acquisition profit or loss or movement. Okay, now similarly, we also have that situation with respect to evaluation reserve. Therefore, let me shift this down. And let me also see whether there's a movement in evaluation reserve. Sorry. I need to shift it to step downwards. Okay, split of pre-acquisition In this case, evaluation surplus. Okay. Okay, now what is it? Let me put evaluation in front. Okay, what is our evaluation reserve for as at reporting dates? It's 20 for the subsidiary. And also, since the date is date of acquisition, it's also 20. Therefore, there is no movement for both categories of reserve, which are retained earnings and evaluation reserve. Therefore, we've left that side. The next thing is that since we are to measure, we are given two options to measure NCI. Non-controlling interest was first measured at proportionate share. Let's look at that. In that case, we come here with what is our purchase consideration? Our purchase consideration is 200 million as the investment of Pali in Suzy. Remember, all figures are in millions. We'll measure NCI later, but what is the preferential capital of Suzy is 120, as you can see. Now we have two categories of reserve. I think I can show this. Since there's no, what's it called? Impairment of goodwill as provided in the question, I can take that out. Okay. Now, this is for the retained earnings, and second one is for the evaluation reserve of Suzy. Okay, and this is, we have it here, 60, and we have the other one here, 20. Therefore, when we sum everything up, is 200. Okay, we need to measure NCI at proportionate share. And what's our percentage here? Our percentage is 20%. Okay, it's 20%, yeah. Okay, which means 20% of how much? 200 million. You can see it here. If I change this to 200 million, and what's 20% of 200 million? 20% of 200 million is 40. Therefore, I can link this 40 here. And ultimately, I have my partial goodwill to be 40 in this case. Now, what is key is that there's evaluation reserve. Okay, I'll come down here to carry out fair value measurements or fair value adjustment, as the case may be. Now, the information given to us here is that in line with IFRS 3, at acquisition date, all of the assets and liabilities has been measured at fair value, have been measured at fair value. And what we discovered is that the fair value of all assets and liabilities are the same with the carrying amount, or they are not materially different. But there's an exception. The exception is that the fair value of plant was 130 million, whereas the fair value of plant was 150 million, whereas the carrying amount was 130 million, where the fair value was 150 million. But this fair value has been, the adjustment has been made, and you can see the adjustment here, which is reflected as a valuation surplus here, all because the accounting policy of subsidiary supports this. And I'll take us back to what Esther read the other time. And I think it's somewhere here. Okay, can you read this again? I want somebody to read this. Esther, okay, can you read it again? In calculating goodwill.
Okay. In calculating goodwill arising on consolidation or gains from a bargain purchase, the net asset of the subsidiary should be restated at its fair value. And there exist two possible ways of achieving this. A, the subsidiary might have incorporated all necessary fair value adjustments in its financial statement, as this accounting policy may support measurement at fair value, such as financial instruments, biological assets, investment property, some components of property, plant, and equipment, etc. In this case, we may consolidate directly as the asset and liability have been restated at fair value and pre-acquisition adjustments have been effected.
Now, that is the scenario we are solving currently, which means we don't need an adjustment again because it has been recognized. And you can't recognize it twice, otherwise you are committing another blunder. Therefore, in this case, what then do I do is that this has been done, and that's why it's already here. And that's why you find out that our asset has been reflected at 150. Therefore, what then happens is that means that this stuff I want to do here will not be required. Probably it will be required for the second question. But as we have now, this is what we have gotten, and as at that point in time. Now, there is no post-acquisition profit, or because it is zero. Why? We all agree that it's at acquisition date. And that's why this is zero, which means you don't need to do anything there. It's just zero, as the case may be. Likewise, what is Pali's retained earnings at acquisition? It was 140. We put 140 there. Now, it has nothing to share because it's also zero, as we have said earlier. I can take this 20 off and replace it with zero. Okay, now there's nothing like impairment of goodwill. I take that out. Now, at the end of the day, we have 40 as NCI, which has not changed because we are still at the date of acquisition, and the parent reserve only, which is also 140. And in this case, the parent does not have revaluation reserve. Therefore, nothing of such happens. And therefore, when we produce our account, PPE automatically will be 150, sorry, 300 plus 150, and that should give us 300 plus 150. Goodwill, we can link that 40. Current assets is 120 and 70. Let me turn on the spotlight. 70, sorry, 120 and 70. And that will give us 190. Therefore, our total asset is 680. Share capital is that of parent alone, which is 400. Consolidated retained earnings is not consolidated because we are still at acquisition and we are only recognizing that of Pali. Okay. And that is what we have here. Okay, non-controlling interest is still at acquisition, nothing has changed since acquisition. And current liability, we have 80 and 20. And that should give us 100. Now, we are okay with this. Now, again, the second option, which will not materially be different, is that NCI is now measured at acquisition date fair value. As usual, we take the market price. Now, what is it? This has not changed. Our concentration of 200 has not changed. And likewise, this has not changed. Also, sorry. Okay, I take this out like the other time. Okay, now we have the same thing here. 120. I can link this. 60. I can link this. 20. Okay. Now what else? Now I need to fair value NCI, non-controlling interest. And in this case, we're given the market price at 2 naira. Okay, it has not changed, but we don't know the number of shares. Therefore, I know the 2 naira, but I don't know the number of shares. Therefore, I can come down here to carry out that process. The share capital of Susie equals the ordinary share capital times the nominal price. What is the nominal price? The share capital is 120. The nominal price is 1 naira. I substitute for it, which then means that I can find my number of shares by dividing $120 million by 1 naira. And that should give me what? 120 million divided by 1 naira will give me 120 million shares. Now, out of that 120 million shares, NCI has a stake of 20% in it. Therefore, I consider 20% of the 120 million shares. Remember, it looks as if nothing is happening, all because we are using 1 naira, and that is the nominal price. Remember, the price can be 50 kobo, and can be otherwise, can be 2 naira, can be 5 naira, as the case may be. Therefore, this gives us 24 million shares. Now, these 24 million shares is what we'll use to value the non-controlling interest at acquisition date fair value, which is at 2 naira per share. And that automatically will give us 2 naira times 24 million shares, will give us 48 million naira, which we are going to use in determining the amount of our goodwill. Now, invariably, our goodwill here, as we have seen it here, is 48 as compared to the other one that was 40. Okay, that is that. Now, we've finished all what we have. Again here, as we have said earlier, NCI, there's no share of profit because it's 0. Likewise, for the parent also, because it is 0. And there's nothing like impairment of goodwill here, which means to come back and say this is 0. This is 0. And this too is 0. And what is our reserve of the parent at acquisition? 140. We come here, this is 140. And that is it. Therefore, we link it up and say, this remains the same at 450, but our goodwill has changed to 48. Okay, Our current assets remain the same at 190. Our equity remain the same. And here, our reserve also remain the same because it has not changed. SCI is measured at fair value, which is 48, and we see have it there, and it has not changed because there's no post-acquisition activity. And our current liability has not also changed, which means this reflects what has been read, that we should just proceed and consolidate as if we are not even aware that there is a fair value measurement of the identifiable asset and liabilities acquired, or because it has already been captured and reflected in the subsidiary's financial statement on its own. Therefore, that is that. Now we'll compare this with this. Now, this is the second one, which I want you to read again, where we have not captured the fair value in the books. And what will be the effect of that? Okay. Sorry. Okay, I want you to read. No, it's not showing well. Okay, it's clear now. Okay, can you read it here? Or I switch it here for you to read.
There will be the fair value of the identifiable asset.
Start from scenario B, okay? Over to you.
The fair value of the identifiable assets and liability of the subsidiary have not been recognized upon acquisition in the financial statement of the subsidiary as stated below. Illustration 11. Pali PLC acquired 80% of the equity share capital of Suzu PLC on the reporting date 31st December 2015. At the date of acquisition, the fair value of Suzu PLC plant was 150 million, whereas the carrying amount, the book value of the assets and liability equal the fair value. Upon acquisition, the statement of financial position of the two companies on this date stood as follows. Statement of financial position at 31st December 2015. Pali plant is 300, Suzu 130. Investment in Suzu PLC 200. Current assets for Pali 120 and Suzu 170. Share capital and reserves. Equity share capital at ₦1 per share for Pali 400 and Suzu 120. Reserve for Pali is 140, Suzu is 60. Current assets for Pali 80 and Suzu 20. Total equity and liability is 620 for Pali and 200 for Suzu. Assuming the prevailing market price of Suzu's shares prior to the date of acquisition is ₦2 per share. Required to prepare the consolidated statement of financial position at 31st December 2015, assuming the non-controlling interest is measured at acquisition and the proportionate share of the subsidiaries identifiable net assets, which is assets and liability B. Non-controlling interest is measured at acquisition at the fair value of equity instruments of the subsidiary. Thank you.
Thank you. Let's now continue. Now, let me just copy the template here, so I don't need to start it all over again there. That's right. I'll copy and paste it. Okay. This we've done that before, so that we don't repeat it. Okay, also here, I've done something here before. I'll just copy it. connecting. Again. Okay. Now, if you check the questionnaire, you'll find out that the fair value is not reflected in the books of the subsidiary. And I can agree with you here that it's because the subsidiary accounting policy is cost. And that will take us back to what we read earlier here. You know, here, you'll find out that if you check here, you find out that under this was the first possible scenario. But what about the second possible scenario? Can you read the second possible scenario? Can you read the second possible scenario, which is the fair value adjustment may be required?
Okay. The fair value of subsidiaries net asset and acquisition. B, the fair value adjustment may be required as a consolidation adjustment without being incorporated in the subsidiary's financial statement. In this scenario, we need to make all necessary adjustments at the point of consolidation, that is upon preparing the group accounts.
And that's what we wanted to do now.
Okay.
Now, since the fair value has not been reflected in the subsidiary's book, we will track this as a group adjustment, which will continue to carry on year upon year, starting from the date of acquisition. Therefore, what do? We'll come here. I can start with name it fair value adjustment. Plans. All figures in millions. Now, I'll compare the fair value of the plants with the carrying amount of the plants. What is the fair value? 150 according to the question, which we have here. And the carrying amount is what you see in the balance sheet as at the acquisition date. Remember, we are still at acquisition date, and it's 130. Therefore, what is the difference here? Or let me just find the difference of using negative sign. What is the movement? The movement is, for an asset, it is positive. Now, if you go back to it, if an asset is positive, what do we agree it will be? Let's go back to our notes. We said, out of this first scenario, which scenario is applicable to the question we have at hand?
First.
Scenario 1.
Scenario 1. What is this scenario? Yeah. Okay, let me highlight it. Is this scenario? Okay. Therefore, what treatment are we going to give is that since our fair value of an asset seems to be higher, therefore, it gives us fair value gain. It gives us fair value gain. Therefore, I'll write it as fair value gain on plants, which is at acquisition date. Okay. Now, what treatment will I give? Treatment of fair value gain at acquisition. Now, treatment of fair value gain. This is fair value gain on assets. This is an asset. And as we have said, the asset will increase in value. Plant. This is an asset. And with credits pre-acquisition reserve. With what? With the 20 million. Now do so. We have impact when we are to consolidate. Now let's start with our first principle. The purchase consideration still remain at 200. NCR will be measured at acquisition date proportionate share, but at that point, we determine the ordinary share capital of SUSI, which is 120. Pre-acquisition reserve, as we said earlier, was 60. Now, the sum of what we have here is what we call carrying amounts of the acquired net assets at acquisition date. Now, which means that is how much? It's 180. How do you get 180? I sum it up. But the standard says where the fair value is different, we need to reflect the fair value of net assets at acquisition date rather than the carrying amount. Therefore, that makes us to recognize what we call fair value adjustment on that plant. I'll put it in a separate column. Let me say red. Now, this fair value adjustment is positive, therefore, is to increase our pre-acquisition reserve, thereby increasing our net assets by how much? By 20, based on this accounting entry. Therefore, automatically, our next, let me show this also. Just shift this one back downwards. Okay. Now, I'll call this now which means this 200. Or because of the increase arising from the fair value, I'll call it fair value, not carrying amount. Which means at this point, we cannot compare apple with apple because the concentration is already measured at fair value. Therefore, and that is this 200. At that point in time, I can come back to say NCI is measured as 20% being proportionate share of 200. And I'll come here and say the 20% multiplied by the 200 there, and that's 40. That 40, I can always bring it back here. And you see that we see I have the same situation, and that's just it. Which means the result we have here is the same result we are going to have here. Let me just copy it. The goodwill, I link it. And my retained earnings, I've not completed that. And that is 140. And again, here I have 0 because we are still at the date of acquisition, nothing. And no impairment, as we have said earlier. This also we have 0, what we've done before. And therefore, I'm able to link my NCI also. And we are back at the same spot as we had in the first solution. Same spot. Which means whether the policy support or not, we'll still have at the same position if we follow the principle. If the accounting policy requires the subsidiary financial statement to adjust for it directly, which that means upon consolidation, you just go ahead to consolidate without further adjustment. But if the financial statement and the accounting policy of the subsidiary has not reflected because the policy is different, in that case, we will now make that adjustment of the books of the subsidiary as part of adjustment at the group level, only upon consolidation. Therefore, let's replicate all what we've done before, and we'll come back here, it's still 200. Now we have 120 here. Okay, we still have our 60. Now, as I've done here, I think I can repeat the same thing here. Let me just shift this downward. Okay, I can take my approach I have here. So because I will use this word later, let me just keep it somewhere here. Let me just keep it here. I'll come and pick it later. So let me just copy this. I'll paste it here. I call this paste it back. Okay. Therefore, I don't use this. I can start it all over again myself. Now, share capital is 120, as you remember. Pre-acquisition, we have it here, 60. Now, remember, this one doesn't exist before. We are not in that, because that's not our own. It's not for this question, because it has never been recognized before. Now, our fair value adjustments, as you can remember, it was done here, which is this. And that gives us the 200 we have. And therefore, this measurement here will not necessarily change from what we already have here, because that is independent of the market. Therefore, I can copy all of this. Sorry for that. Okay. Therefore, this is perfect. I don't need to take it there. It's still the same thing. Therefore, I can come here and say our fair value is 48, which we've not done here, we've not updated, because this is 20%, not 100, and that changed everything up back to 48. Okay, from there, we have our 48, which is not different from what we had here before, which is this 48. Now, which means regardless of what the situation is, we still get the same results. SCI now, what we have deduced here is that we are going to get the same results with or without the accounting policy of the subsidiary supporting fair value requirements. And that is what I've tried to achieve with these two illustrations. Any question on this so far? Okay, if there's no question, let us now use this to reflect on the next question. Who will volunteer to read scenario C? From our question bank here. You start with scenario C on top here. Who will volunteer?
Okay. Scenario C, the effect of fair value adjustment on the subsidiary's net asset acquired can be considered subsequent to acquisition where the subsidiary did not reflect fair value adjustment. It means financial statement upon its acquisition by the parent company. The illustration below will be adopted in showing the subsequent effects of the fair value adjustment on the consolidated financial statement as at reporting date, subsequent to the acquisition date. Illustration 12, Pali PLC acquired 80% of the equity share capital of Suzu PLC on the reporting date 31st December 2013. At the date of acquisition, the fair value of Suzu PLC plants was 170 million naira, where the remaining economic life of the plant is 10 years, whereas the carrying amount, which is the book value of other assets and liability, equal the fair value upon acquisition. At the date of acquisition, the subsidiaries' retained earnings were 40 million naira. The statement of financial position of the two companies on the reporting date, 31st December 2015, stood as follows. Statement of financial position as at 31st December 2015 for Pali, plants 300, Suzy 120, investment in Suzy PLC is 160, Current assets 120 for Pali and Susie 80. Total asset is 580 for Pali and 200 for Susie. Share capital and reserve. Equity share capital at ₦1 per share for Pali is 400, Susie 120. With retained earnings for Pali is 100, Susie 60. Total equity and reserve is 500 for Pali, 180 for Susie. Current liability 80 for Pali, 20 for Susie. Total equity and liability for Pali is 580 and 200 for Susie. Assuming the prevailing market price of Susie's share prior to the date of acquisition is ₦2 per share, required, prepare the consolidated statement of financial position as at 31 December 2015, assuming a non-controlling interest is measured at acquisition at the proportionate share of the subsidiaries identifiable net assets and liabilities. The non-controlling interest is measured at acquisition and the fair value of equity instruments of the subsidiary. Thank you.
Okay, thank you. Now, this has been transferred to our Excel template. Now, let's go back to what I like doing, to put up the structure. Even though in the last question I didn't do that, but let me just do this. The group structure. As Pali. As a parent, and Susie as a subsidiary with 80% stake. We have NCI with 20% stake. Now we are told that the date of acquisition was 31st December 2013. And date of consolidation, which is our reporting date, is 31st December 2015. How many years apart is this? From the reporting dates?
2 years.
2 years.
2 years. We need to be very careful because don't be deceived by 2013 and 2015 so that you don't count 2013. If this is the 1st of January 2013, probably it will have been 3 years. Therefore, I'll copy this and paste it where it's supposed to be there, or because sometimes this provides some guidance and clarity in the whole process of what we're doing. Therefore, I find a slot for it here. Okay, I think it's okay where it is here. Now we can continue. Now, the stake remained 80-20. But now, at acquisition, our reserve was 40. But at consolidation, our reserve is 60. Is 60. Therefore, I'll come here. 60 is still correct, but pre-acquisition is 40. Which means we have post-acquisition of 20. Now we come back here. I take off all of this. And I'm doing this because I'm supposed not to do that, but I'm doing this so that it doesn't confuse you from your flow. But in reality, I don't need to do that because it's a template. As I'm making adjustments in various sessions, everything is populating on its own. Now, let me also take this so that you know you are working with a blank sheet. Okay. Now, let's start with this. Purchase consideration was 160. Therefore, I have to correct for that here, or adjust for it here. 160. And there's no pre-acquisition, the same way there's none here. There's no pre-acquisition for retained earnings. Therefore, my pre-acquisition for retained earnings here is 40, but there's no pre-acquisition for evaluation surplus. Rather, we are the one to effect the adjustment. Therefore, I come here to say this is 160. I'll come back to measure NCI. The share capital still remains at 120, while the pre-acquisition reserve is now 40. Which means the kind amount is 160, and I need fair value. But if you come back to the question here, the question says, that at the date of acquisition, the fair value of Susie's plant was 170 million. I'll come here to recognize that fact, 170 million. And we are told that the remaining useful life of the plant as at that date was 10 years. Whereas the kind amount or the book value of other asset and liability equal the fair value. Now there's something here, there's no information with respect to what the carrying amount of that plant was as at date of acquisition, being 31st December 2013. Which then implies that the information is not made available to me directly. And it will be wrong for me to come to my balance sheet and assume that this 120 is a kind amount as at 2013, whereas this is a balance sheet of 2015. Coupled with the fact that it's a plant, supposing it's like land, I might presume that the land is carried at cost and nothing has happened to the land since 2013. But because this is a plant, which is a depreciable asset, which is contrast to a land that in most jurisdictions is not depreciable asset because of it can be held as far as practicable and the useful life may become indeterminate. Therefore, in that case, I need to now use my knowledge of IAS 16 to be able to solve this problem. And what is that? We'll discuss it in this notebook. Now, let me take us back. I'll take us back to basic principle. Basic principle of ascertaining the carrying amount of PP at any given reporting date. And this principle is based on all things being what? Equal. Let's assume all figures are in thousands, which means your kind amount at the beginning, or what you call your book value, for, let me say, a plant. Let's say it's 1 million. Now, what are the things that can change it? Things that can change it, we either increase it or reduce it. Let's start with things that can increase it. One, where there are additions during the year. For example, let's say we bought additional equipment for 200. Things that can increase it is when you revalue during the year, let's say 100. Things that can increase it is when you transfer in, and usually from capital work in progress. Imagine you are constructing that plant until it's completed before you transfer it into plant category. All of this we'll discuss it when we get to IFRS 16. But I believe since we are all chartered accountants and senior professionals, we understand what I'm talking about at this point. Therefore, let's say it's 50. For now, let me assume these are things that can bring about increase. Now, what are the things that can bring about decrease? Depreciation, charge for the year. Impairment, charge for the year. Disposal of asset during the year, and probably transfer out to other class. Okay, it might not be possible for plants.
Valuation deficits.
No, that is impairment. When we get to IFRS 16, you understand why we won't call it evaluation deficits. But impairment takes care of that. But remind me, we'll discuss that extensively. And this, I've assumed there's no impact of foreign exchange on this, or because we assume that we are buying in Naira, our functional currency is in Naira. Otherwise, I might have more or less infused impact of FX movement in it. But for now, I want to simplify it. Therefore, all of this brings about reduction. Let me say 400. Let me say 80. Let me say 10. Let me say 20. Now, all things being equal, my kind amount at the end or what you call the book value can somebody press calculator? Do you have a calculator there? Let me also put up my Excel here. $1,000, 200, 100, 50, negative 400, negative 80, negative 10, negative 20.
840.
My Excel will not lie. 840, yeah. Okay. Therefore, this 840. Now, what am I driving at? This brings about decrease. Now, one thing you check here is this. These things I star or I will circle are driven by events. They are not necessarily what you come across on a yearly basis. Events or activity driven. Whereas the one I will highlight in yellow is something you come across every year, even in the period of interim abandonment or non-use of an asset, which we discussed under IAS 16. And what am I driving at is that depreciation is just a way of allocating the cost of an asset over time, which means whether you are optimally or suboptimally making use of that asset, you see charge depreciation in a systematic manner that reflects the pattern of consumption. Whereas if you don't purchase an asset, you won't have addition. If you don't adopt a valuation model, or when you adopt a valuation model and there's no material difference between the kind amount and the valuation amount, you won't carry out such an activity or adjustment. Likewise, if there's no asset that you are building or developing and has not reached the point to which is available for the intended use, there won't be issue for transferring or transfer out. Likewise, if there's no events that triggers possible impairment of a plant, there won't have been impairment. And if you have not disposed of an asset, there won't be disposal. You can now see that the only one that is left out is depreciation, which speaks to the question at hand. None of this event or activity was given other than the fact that the plants compulsorily would have been depreciated. Now let's go back to the question. Now the question then is, since we don't know what the kind amount is, the question then is, it becomes X, and we need to find X. It becomes what? X, and we need to find what? X. Therefore, what is X? There are many ways of finding X, and I'm going to do it in this way. I'll go back to my notes. Look at what has happened. As a date of acquisition, which was 31st December 2013. The value of the assets was unknown, but we know some variables or other factors that says that the asset has useful life remaining so that the date of asset retirement, which I call DUA, which means the date in which an asset has outused its useful life, which means the asset has reached its end or terminal point. Remember, we are told that it is 10 years, which means if you have 10 years to this, I believe the asset should have outused its useful life by 31st December 2023. And what will have been the value at the terminal date? Who can tell me? And why? What will have been the value at the retirement days? Who can tell me? Hello?
I would say so.
Yeah, I said what will have been the value of the assets at the retirement date? Asset that has outused its useful life, what is always the balance of the value?
That will be the scrap value. Scrap value.
Residual value, I guess.
Yeah, thank you. Thank you. It is the residual or the scrap value, which people would have assumed that it is zero. But residual value can be zero and can be positive value. It's only zero when an asset is estimated not to have a disposable value. But it is positive value when it is estimated that it has value you can salvage, regardless of the condition at the point of its terminal year. Okay? But in this case, since we are not given information about any estimate of disposable value, we assume here that it is what is zero, which is a fair assumption. But if the examiner or any information that will point in direction towards estimation is given, that is the value we use. Now, between these two periods, there's an intervening period. An intervening period is today, which is the date of consolidation, our reporting date, that 1st December 2015. I recall that the distance here is 10 years, according to information given to us. Because from date of acquisition, we are told that this has 10 years remaining. And that's how we are able to arrive at this period. But the question is, what is the value as at today? If you go back to our balance sheet, our balance sheet shows that the value today, which is 31st December 2015, for that plant is 120. And what that presupposes is that this is the value after depreciating that plant in the last 2 years from the date of acquisition. And this is premised on the information made what? Available, which means as at this date, it is 120 million in naira. Now, what are we trying to buttress? We are trying to buttress the fact that between this period and this period, 2 years has gone. And that's why I told us that we should much more be circumspect to this period here, to this date. And this date will give us these 2 years. And that 2 years is still what is haunting us here. And these 2 years reflect years where depreciation has already been charged. They have already charged depreciation for 2 years there. And that is X minus depreciation charge over 2 years is what gave us 120. Since we have all agreed here that none of this has occurred other than depreciation. Which means that if any of this has occurred, you also need to know how you work back from your today to your yesterday. Which means in this case, you'll be adding back this and subtracting what you added before. Now, the question then is, how many years left? Eight years remaining. As of today, till the end of the life of the assets. Which then means that if we assume, which is a fair assumption, except otherwise stated, that depreciation of such an asset is on a straight line basis, which means a straight line method of depreciation. Therefore, what will happen at that point in time? What will simply happen at that point in time is that we can now come back and say, recall how we compute depreciation. Annual depreciation, which is on a straight line basis, is always the cost minus the residual value, or what you can call the scrap value or the disposable value, divided by the useful life. Now, let me try to write it clearly. Now, since we are some years away, I can use surrogate as follows to determine my annual depreciation, which means instead of cost, what I have is carrying amount. I can say carrying amount minus the residual or scrap value over, instead of the useful life, it will now be the remaining useful life, which in this case, the carrying amount is 120 in millions of naira. The residual value is 0. In this case, and the remaining years is what? 8 years, which gives me 120 million over 8 years. And that should give me 15 million per year. Which means if 15 million is per year, I can averagely conclude that the 2-year depreciation already charged, as you see above here, is simply 2 years times 15 million, since we have been able to determine the depreciation per year. And in that case, it means they've already charged 30 million in the last 2 years of acquisition. Now, which means if they've charged 30 million, I can simply say this equals 30 million. And if I'm to work back to find X, I'll say the depreciation, the carrying amount at acquisition date to be equal to the carrying amount at reporting date plus 2-year depreciation already charged. And that gives me 120 million, add back 30 million, which is simply working back. And in that case, it will give me 150 million. And in a simple analysis, this 150 million has an equivalent. The equivalent is the same thing as saying 15 million per year multiplied by the entire 10 years from the date of acquisition. Which is this equivalent I'm talking about. Which that means that we can reach a conclusion and say, at a glance, we've been able to resolve that puzzle of what the kind amount was as at acquisition. Peradventure, the examiner or information available from the client or whatsoever it is not directly giving us what the kind amount was as at when acquisition took place. Conversely, I can take a short route by way of mathematical expression, which means I can say approach 2. I can say by way of what problem that if 120 million being the depreciable value, and what is a depreciable value or depreciable amount? It is a cost less the residual value or the kind amount less the residual value. Is to be depreciated over a period of 8 years remaining. If you remember, this 120 is to be depreciated over 8 years, given that the residual value is 0. That's why I said the depreciable value is different between 120 and this residual value. If this have to be depreciated over the remaining 8 years, out of the original 10 years of the sum of value of what? X. Because this 120 is a fraction of this X based on the fact that 8 years is left out of 10 years because 2 years have been depreciated. Therefore, I'll now say, what then is what? X, which in a simple arithmetic algebra or mathematics class, they'll say find X. Okay. What then is our X here is to say simply for short, 8 years multiplied by X equals 120 million multiplied by 10 years by way of cross multiplication, which means I can now say X, which is the subject of the formula, is 120 million times 10 years, all divided by what? 8 years. And when you check it, all things being equal, X has found itself at 150 million, which is the same thing as what we have here. Which means your understanding of basic principles will be key and instrumental to solving problem directly or what? Indirectly. Any question on this so far?
None for me, sir.
Any
Thank you
contribution?
very much for the systematic
Okay, thank you.
simplification of this solution. Actually, my question is in respect of the second depreciation method, which is a reducing balance method. So I want to assume if I did been the examiner, or let me say the client is actually making use of the reducing balance method where a particular rate is being given, how can we actually arrive at something like this? Because I see that the useful life actually help us to
you are going to do the same thing, but it's not going to be as straightforward as this.
estimate this.
You understand? Easily with the aid of spreadsheet, you can always walk back instead of constructing mathematical equation. Excel, which is a spreadsheet, will help you to solve it because you are looking for unknown, given that you have most of the parameters of measurement. Does that make sense? Does that make sense, please?
All right, sir. All right, sir. Thank you, sir.
Okay, I can copy this stretch and add it to my Excel model, which I can equally build on the model, but I like using this illustrative stuff to make us better appreciate so that we can follow it step by step. Because some people still have Excel phobia.
Yes, sir. Thank you, sir.
Yeah, some people still have Excel phobia, so that once they see Excel like this, is like everyone want to fall. Therefore, I just copy and paste it beside you here so that I can see it for reference purposes. Therefore, which means we can come back here and since we know our X, before X has cost wahala, therefore I now know my X. And what is my X? My X is 150. Let me put it somewhere here as derived. As usual practice, let me find my arrow. Let me copy one arrow here and put it here so that this 150, where do we get it from? It's from this 150 here. Let me find another arrow. I think I have one blue arrow somewhere. Okay, I think I will use this one. The same 150. So same 150. That arrow is coming from here. So that we understand that there are various ways to get into problem solution. Okay, now we've gotten that, which means my accounting entry remains the same. Now let's move further. Now let's try and find this, which is 120. We've gotten it. This kind amount will not be required for us to determine if the information has been given to us on a platter of what? Gold. Okay. Let me make it a mix of purple and sorry, not that. A mix of purple here, and I'll make this one orange. Because I like using color to make people appreciate and it speaks volume. Okay. That's not fair. Okay. I have purple stuff here. Let me use it rather than the red. Because I never use red in driving that. I use purple. If we only use purple. Yeah, that's. Okay. I'm satisfied now. Therefore, now what is my NCI? My NCI is 20% of 180. %20 of 180, and that's 36. I can leave my 36 here. Okay, which means my partial goodwill is 16. Okay, now let me quickly do for the second assumption. I think it's still going to be the same. Okay, but my stuff is not 200, but 160. I remember all other information relating to this remain the same because the market has not changed from the information made available. Okay. Now, there's something we need to take note of. Now we have moved, if you come back to this analysis we did, okay, it's already here. Let me use my spotlight. Now you find out that this 30 was what was charged in arriving at this profit of the subsidiary, which was 60, and of which we determine the post-acquisition to be 20. But we are saying that if the subsidiary has reflected this fair value of plant, which is 170 million, if he has reflected it in our subsidiary's account, 170, the subsidiary will not have charged 30 million as depreciation, which means the subsidiary has under-depreciated the assets. And by so doing, he has overstated his profit. Because if you have charged depreciation on the basis of 170 and not 150, I can tell you vividly that the depreciation will have been higher than 30 million for the 2-year period. And therefore, the profits of the subsidiary will have reduced. Which then means that let us keep a track on the depreciation adjustment. Depreciation adjustment on plants measured at acquisition date fair value. Therefore, there are two approaches. Approach one. The approach one is that I'm going to compare two things. I'm going to compare two things. I'm going to compare depreciation based on fair value. And that will be, remember, the fair value was 170 million. And there are 10 years to go, which means divided by 10. And remember that there's no residual value, which means let me just shorten it so that I can put the residual value there in case you have residual value. Million minus 0 will give us favorable amount. And we have to do that over 10 years. And that would have given me 17 million per year. But the 2-year depreciation, let me add S to say charges. The 2-year depreciation, which means between December 2013 and December 2015, means that I have to take 17 million per year for 2 years. Therefore, I'll multiply this by 2 years. Which means invariably, it means it's 34 million that the depreciation is supposed to be for that 2 years. Which means I'll come here and say 170 minus 0 divided by 10 multiplied by what? 2. It gives me 34 million. I'll compare this with what the subsidiary has charged, which is based on the carrying amount. Which you can pick directly from here as 30, or you can replicate it here also. Therefore, okay, in this case, it is 150. That was the carrying amount. And therefore, if you use the same formula, I'll just change 170 to 150. It will give me back the same 30 million we have here. Which that means that what is the difference? It means if you have charged on fair value, depreciation should have been 34 and not 30, which means you have undercharged depreciation. And it then means that this is a 2-year depreciation adjustment that needed to be effected in group accounts. Therefore, how do I do this? There are 2 ways I can infer this depreciation. The first is that I can use it to reduce the reserve of the subsidiary so that this reserve is no longer 60, but it is 60 minus 4 because you have not charged 4. Or because if you have charged 34, this wouldn't have been 60 in the balance sheet. And likewise, the asset wouldn't have been 120. Probably the asset will be lower, and we're going to see that later. But I don't usually use this approach. I still leave this as 60, not to create confusion. But I will assume that first, I have distributed this 20 between the parents and the NCI. And since I've distributed 20 before to them, and I just discovered that I've not charged depreciation of additional 4, it then means that I will charge this 4 to each one of them in order to get a refund. It's like a principle of I've overpaid you and therefore refund the excess. Or if I'm fortunate that I've not paid you, I will have deducted the amount I need to deduct, and what is left, I can charge it. And therefore, that becomes a position. Now, in this case, see the approach I'm going to use first. Accounting entry or treatment. Is that the treatment I'll give is as simple as those. That I'm going to charge that for to both the parents and NCI in ratio the share profits or loss. The consolidated retained earnings, or what I can call group reserve, will take care of 80% of the parents and the non-controlling interest account will take care of the balance of 20%. I remember, since you have undercharged depreciation, it means you have overstated your asset value. Therefore, to reduce my asset value by the excess or by the undercharge, I'm going to credit my group plants, which is an item of property, plant, and equipment. Therefore, what will I do? I take 80%. Remember, I have the 80% here of the 4 million. That's 3.2. 20% of the 4 million. That's 0.8. Altogether, if you sum it up, it will give you this 4, which is the same 4 you charge to your group assets. And that is that. Now, this is the approach you can use. And we are going to compare it with the other approach, which is going to give you the same results. Okay. Now let's look at second approach. The second approach here is that the 2-year depreciation adjustment is equal to, if you look at it, there are common factors here. And what are the common factors? The common factors here are what are likely highlights. Okay, don't worry, I'll circle them. 10 years is a common factor. Let me erase it. Let me take it out. Okay. $10, $10, and $2, $2. Now, the common factors are what I've highlighted as 10 and 2 years in each of them. Now, what I'll do is that I'll come here and say 2 years of the depreciation has been charged out of 10 years. And the only source of difference between them is the difference between the fair value and kind amount, which is this 170 and 0 and 150 and 0, which means is the difference between 170 and 150, which is exactly this 20 we are seeing here. Which that means that if we have this understanding, it then presupposes that that should give us the same thing. And this is only premise on the fact that the methodology you are using is for depreciation is straight line method. Otherwise, if it's not straight line method, you won't be able to use the second approach. You can only use the first approach by doing it one by one. Remember discussion we had earlier when we talked about reducing balance method or any other methodology that is not straight line. And therefore, what do? It will be 2 over 10 years multiplied by this difference of 20. And that will give us the same result of 4. Which means approach 2 will be suitable and very straightforward when you are confronted with straight line method, which is usually the method you might come across much more in practice. Okay. Therefore, we've done that. Now, what will be the effect of that? The effect of it will be at the point of measuring NCI. Okay, and I'm going to do that here now. NCI here, 20% of post-acquisition, which is 20. We update our record here. And we say 20%. We already have the percentage here of 20 million. And now we'll say less additional depreciation. Let me give it a different color. And what's the additional depreciation? We said we should deduct it 0.8 from NCI. Okay, now I can sum it up. And that gives us 39.2. Also, the parent has 100, ascertain earnings now is to share 80% of 20, and that is 104. But remember, there's additional depreciation. Here is 20% of the 4 million. So that you trace the adjustments. And this one will be 80% of that, which is 3.2. And when you sum all this up, okay, we've not done this. This 80%, not 20% for the parents. Okay, and everything here is 112.8. And that is that. Now, invariably, what do we have here? PPE, we have 320 plus 120. But remember, we have an adjustment here that says we should revalue upward. 20 million to plants. We'll put that 20 million here. I will asterisk it so that you know what it is. And 2, we have 4 million. We are told to deduct because of excess depreciation, which is 4 million under depreciation in this case. And I put 4 million. I'll also asterisk it because it's an adjustment. And therefore, what do we have? We have 300 plus 120 plus 20 minus 4. Okay. Goodwill is 60, which you have here before. Current assets, remember, that's 120 and 80. That's 120 and 80, it's 200. Ordinary share capital, that's 400. Retained earnings, consolidated, that's 112.8. SCI is already linked, 39.2. Acquired liability is 80/20. Okay. And that's how we arrive at what we have. Now, our SCI was measured and it has not changed. The only thing that is changing, this has also not changed. Okay. Now, what is changing? We have it here, as I've done earlier. Now, this is our 20%. Multiplied by 20. And this is what we have as an adjustment here. Okay, and that gives us 51.2. This we still have our 100. Okay, and what we have here, can copy and paste. And this will give me 80% of 2016. And we have this, which is the adjustment we are told to make. and it still gives me 112.8. Therefore, I can take this back. Goodwill, 28. This still remains the same. This remains the same. And luckily for us, this still remains the same. Now our NCI is slightly different at 51.2, and this remains the same. Okay, which means we've seen the effect of fair value adjustment we made at acquisition, how it affects or impacts our post-acquisition profits with respect to depreciation adjustment. Now let me see if I can line this in red. Okay, now, as I was saying earlier, that instead of me retrieving this money back, assuming I've shared this 20, instead of me retrieving it back, okay, there's another approach I can use, which I made mention earlier. And that approach is that I'll deduct the 4, this 4, directly from this 60 million as an adjustment, and the effect here is that it's going to reduce my post-acquisition reserve. Now, let me show you. Now, let me call this 11A, which means approach A we've used. Let me duplicate it now and use it to solve, use approach B for it. Now, what is approach B? Approach B is that I won't use this approach I've done, which is, since I'm not going to debit this, I'd rather debit the subsidiaries retained earnings. I'll debit the subsidiary retained earnings at reporting dates. And if I do that, therefore, I won't need a split. Therefore, I'll leave it as this. And what is the implication is that I'll come here to adjust my subsidiaries retained earnings by saying it is 60 minus that 4 as advice, which means 60 minus 4 means I'll come here and say this 60 minus 4. Where's the 4? This 4 that we have here. And that'll give me 56. Okay. Now you see that automatically it changed my post-acquisition to 16. Okay, because here I've adjusted it. I've adjusted it, and let me put, I've adjusted it. take note. Let me put the asterisk. Now, what will happen is that this will no longer be required. Neither will this be required. And you see that we arrive at the same results. 112,392. Similarly, this will no longer be required. And this will no longer be required. And my position remains the same as it is, which means any approach you adopt, you still get the same results. A and B is producing the same results. And that's the beauty of understanding various approaches to solving problems. Any question on this? Any question on this? Any question?
Not for me.
Okay, yes, sir. Can you just help scroll down a bit, sir? I just want to get it. Okay. Here we said treatment of, I just want to confirm. Here we said treatment of fair value gain on asset at acquisition, but we are still having 4 naira, and we have one earlier. So what's it called? I just want to get clarification as regard the title. Is it still treatment of what's it called? Or is this the treatment of fair value gain or treatment of depreciation, or let me say the under depreciation? I just want to. Exactly, sir.
Okay, we are going to look at preference share capital. And at this point, we'll be looking at what role does preference share capital play in the capital structure of an acquired business or a subsidiary. Now, when a subsidiary is acquired and the subsidiary has a preference share capital, in which the parent may have or not any interest in that preference share capital, what will be the consequence of such in the process of acquisition day accounting and subsequently the process of consolidation? Now, the first thing you need to understand is this: what is preference share capital? Okay, preference share capital by the name means is a preferred shareholder, which then implies that preferred shareholders are ranked above ordinary shareholders with respect to the process of any dividend, and also in the form of liquidation. They will more or less be ranked immediately after the creditors, which are the liability holders or claim holders, and they will be settled before ordinary shareholder. And this is the reason why, because they are not necessarily a risk taker, or probably put, they don't have residual interest in what belongs to the entity, except in an extreme situation where we have participatory share. But again, it's not going to give you such a residual interest or stake. And by so doing, it then means that there's no amount of preference share that you may have in a subsidiary, even up to holding all of the preference share capital of the subsidiary, that will likely give you control or give you control over such an entity, which means if you have preference share stake in a company, even when you hold 100% of that preference share stake, And no matter how greater the preference share is above the equity share, you still don't have residual interest in the ownership of that business. Therefore, preference share capital cannot give you what it doesn't have. And which means that in that situation, no matter the amount you have, you can't use it to obtain control or even consider it as an assessment of establishing whether control exists or not, which then implies that this will not be taken into consideration. But it takes other role with respect to how we consolidate, okay? And there's also possibility that preference share in an extreme situation may contribute to goodwill, but it is very rare. What that means that preference share is expected to cancel itself out between the preference share capital and also the investment attributable to preference shares. Now, when you also look at it carefully, you will find out that preference shareholder does not necessarily participate in the profit of the entity other than the dividend they are considered beneficiary of. But again, in a extreme situation, when you have participatory preference share, they may also equally participate in addition to the fixed dividend, some amount as a percentage from the profit in excess of a threshold that has been agreed with those preference shareholders, which are considered participatory preference shares. But that still does not create a controlling stake or gives a residual interest ownership in such an entity, which means in conclusion, at no point in time are we going to consider or evaluate preference share as a basis of establishing directly, indirectly, or combined with any other equity instrument to ascertain whether control exists or not. And that is that. Now, what that means that the investment made by the parent in a situation where he gain control through his ordinary share investment, but equally have a stake in the non-control in the preference share capital of the subsidiary, such amount will cancel out between the investment and the share of the preference share capital. Whereas any portion that is left, peradventure it doesn't hold 100% of that stake, will be treated as a component of non-controlling interest, which means our non-controlling interest will be all form of equity interest, ordinary shares and preference share, or any other form of equity that is not solely attributable directly or indirectly to that of the parents. Which means that you also see where the impact is, which means in summary, if the parent has 100% interest in the preference share capital of the subsidiary, the entire 100% share capital will be cancelled out with the investment, okay? And usually it should totally cancel out, but where it doesn't, it might create or contribute to an amount of goodwill recognized or negative goodwill recognized. Okay, another one that also exists in the situation is where the parent might have partial, whether 40%, 80%, 60%, or whatsoever it is, which means whatever the percentage is going to cancel out the amount of investment in preference share capital with the percentage he owes in that preference share capital. And that also should nail off, and where it doesn't nail off, it may contribute directly or indirectly to the amount of goodwill or negative goodwill recognized, if any, but it's very rare. Lastly, there's a situation where the parent has no stake, single stake in the preference share capital. It then means that in that situation, the preference share capital will not necessarily be cancelled out, but the entire amount of preference share capital will be only attributed to a non-controlling interest, and all will be aggregated within the non-controlling interest portion of the equity section of our balance sheets. Now, to buttress all of these narratives and to better appreciate the principle and the practice, we'll look at a practical illustration as demonstrated in our material. But before then, I want somebody to read through our material and let us have a fill-up from it. Okay, I want somebody to read this. Who will volunteer?
Accounting for preference share capital in group accounts. It has become a common practice for a parent company, in addition to ordinary share, by which it obtains control of the subsidiary, may have acquired preference shares in the subsidiary. This implies in the separate financial statement of the parent, the amount paid by the parent company for a stake in the subsidiary preference shares or preferred stock will be included in its investments in the subsidiaries, as would have been shown in the company's statement of financial position. Furthermore, as the ordinary share represents part of the net assets acquired, so parent share of the preference share in subsidiary will represent part of the net assets acquired and should also include in the calculation of goodwill as deemed appropriate and necessary. This proposition is acceptable on the premises that in accordance with the requirement of IFRS 32 financial instrument presentation, the preference share are considered as an equity instrument. The parent's investment in the preference share of the subsidiary should not be used at any point to determine the existence of control, as the entire preference share in subsidiary do not at any point give rise to residual interest in the subsidiary. This implies that preference share held by one company and another are normally irrelevant in determining whether a parent-subsidiary relationship exists. This is because preference shares do not give voting rights and therefore could not result in control. The treatment for any preference share not held by parent company should be treated as part of the non-controlling interest, which implies that where the parent does not own 100% of the subsidiary preference share, the other equity interests not of the parent should still be treated as part of non-controlling interest because it is not necessary for the parents to own 100% of preference shares of the subsidiary. In a situation where preference shares are recognized as liability of subsidiary under IAS 32.
Sorry, let's stop there. Now, what I've explained before is what the summary has been given now, and that is from the perspective that preference share itself constitutes an equity. But by the time we get to financial instruments, you better appreciate that preference share can equally constitute a financial liability, which means it can take a form of liability. And it will take a form of liability based on the requirement of IAS 32 if certain conditions exist. But later on, we'll look at those conditions. But assuming it takes a form of liability, we are going to treat it synonymous to how we treat a loan. And whenever there's a loan between the parent and the subsidiary, such will be treated as intercompany transaction, which require elimination. But again, we've not got into group adjustments where we'll see the process and basis of elimination, but that is what this other paragraph and subsequent paragraphs will be speaking to. You can continue from there.
Okay. In a situation where the preference shares are recognized as a liability of subsidiary under IAS 32, financial instrument presentation, they should be accounted in the same way as loan notes, which include debts and or bonds. Invariably, upon consolidation, the preference share acquired or purchased by the parent included in the cost of investment, that is, investments in subsidiary as contained in separate statement of financial position of the parent, should be cancelled out against the preference share capital in the subsidiary. While the portion that is not held by the parent will be treated as a liability to the group and not a component of non-controlling interest. This is because non-controlling interest is a component of equity, whereas preference share usually redeemed, sorry, okay.
Yeah, what happened?
I can't see where, when you moved it, it's like I lose. It's like you move it above where I am.
No, okay, check where
you are. Okay,
now.
I've seen it. Okay, I've seen it. Cancelled out each other then. Are not a component of non-controlling interest. This is because non-controlling interest is a component of equity, whereas preference shares usually redeem and or cumulative preference share may have been classified in accordance with IAS 32 as a financial liability. The implication of investment made by parent company in the preference share considered an equity instrument. Non-common shares of the subsidiaries that the consolidated process of combining the parent and the subsidiary account should involve two stages as stated below. The calculation of the amount of investment in non-controlling interest will include the non-controlling interest in the balance of the net asset that are financed solely by the ordinary shares and the non-controlling interest in the net asset financed by the preference shares. 2. The calculation of goodwill. The calculation of goodwill calculation will equally include goodwill attributable to the parent based on equity interest via common ordinary share or ownership in the subsidiary. I'm done.
Yeah, you can continue.
Goodwill attributable to parent based on preferred stock, i.e. non-common share in subsidiary, if any. Where preference shares are recognized as a financial liability of the subsidiary under IAS 32 financial instrument presentation, they are accounted for in a similar way as a loan held by a parent in the subsidiary. Refer to other section chapter of this text. The conclusion on its accounting upon consolidation is that both the purchase preference share by parent as included in cost of investment and the preference share liability in the subsidiary book will be cancelled out. Wow. We can explore the principle of treatment of preference shares in group account by adopting this illustration. Illustration 1. Arsenal acquired 70% ordinary share of Manchester United on 31st December 2012. When the balance in the latter retained earnings stood at 40 million, a consideration of 220 million, and also invested in the sum of 60 million in 8% preference stock of the company. Property, plant, and equipment 500, 260. Investment in Manchester United 280. Current shares in Arsenal 260, and Man United 280. Total assets of Arsenal 1,040,000, and then 540 in Man United. Share capital reserve, equity share at £1 per share, 600 in Arsenal, 250 in Man United. 88% preference stock shares, preference share capital £1 per share, 100 in Arsenal and 100 in Man U. Reserves, retained earnings 220 in Arsenal, 50 in Man United. So total equity preference share is 910, 400. Current liabilities 190 in Arsenal, 140 in Man United, and total equal 1,040,000 and 540 million naira in Man United.
Okay, thank you. Now, what you can deduce from this question is very straightforward. What you can simply deduce is that in addition to investing about 70% or acquiring about 70% of my shares of Man U for the sum of 220, he equally acquire some stake in the preference shares and to the tune of 60 million, whereas the entire preference share capital issued by the subsidiary, which you can find there, is 100 million, which you can find here, even though coincidentally the parent also is 100, but they are totally different. Okay, therefore, what can we do? Now let's switch to our Excel workbook. Okay, now I'll try and create some things there. Okay, let's first of all start with the structure. Let's build up the structure of our notebook. In this case, I put up the structure as follows. Okay, in this case, the group structure is triggered by ordinary shares investment. Okay, Arsenal in this case, has a 70% stake in Man U. I remember we said it's only ordinary shares that we use to characterize the structure or control, which means this is 30%. Now, the date of acquisition through equity was dated 31st December 2012, and date of reporting was 31st December 2015, which is 3 years apart. Now, we are not interested in when was the period they invested in the preference share, because it will not even be used or assessed as a basis of determining control. Neither will it be used to more or less attribute profit to the parent and non-controlling interest. Therefore, I pick this structure first. I can copy this structure with my tool, and from there, I take it to my worksheet on the spreadsheet. Okay, now I can return to my spreadsheet. This is my spreadsheet. If I can put it here. Okay, I think it's suitable where it is here. Okay, now further thing I need to do, which I can easily do here, is to more or less analysis of Arsenal's investments in Manchester United. Okay, his all investments in Manchester United, regardless of when it is and the nature of the investment. Okay, and I think the investments, there's ordinary shares investments, and we have 8%. Okay, when you see the percentage, what it's simply telling you is that the dividend is fixed at 8% per annum, and that's the reference point. Okay, 8% shares investment. Okay, now it's only this that will be used to assess control. Why this plays no role in control or not. Okay, and therefore, how much was this? It was 220 million. Okay, and in the balance sheet, we have 280 million, if you check, as the total investment. But the later further analyze it to say he also invested 60, which means the difference between 220 and 280 is that same 60. But you need to further analyze it, because it's possible that even when you put the 60, you still have balance, and that might be attributed to other form of investment. And that's why it's good for you to analyze. Okay, but without even doing this equation, the 60 is what is given to us. Imagine what we have in the balance sheet is 290, and we put 60 here. Okay, when you add 60 plus 220, you have 280, which means there is other investment somewhere. That's why it's very key for us to always take that into consideration. Okay, that is that for now. Now, again, let's also break down. Let's break down, that is, break down the preference share capital of the subsidiary. Let's break it down. Doing that, what does it give us? We also use similar methodology. Now, if we go by way of it, the total value is 100, which is what we have here. Okay, let me put up my spotlight. We have 100. Now, this 100, I can bring it down here and say 100. Okay, whereas we are told from this investment we have here that 60 belongs to Arsenal. Therefore, which means if Arsenal invested, let me say Arsenal investments in the preference share is that 60, which we can link to what we have here. Okay, therefore automatically others, which we'll characterize as components of non-controlling interest. Okay, and we treated it as non-controlling interest rather than a claimant because the preference share itself from the account or from information provided is treated as equity rather than as liability. Okay. Therefore, in this case, you can see that the difference then is different between 100 and 60, and that's 40. Okay, now doing this, we can now move further to determine our goodwill. Okay, if any. Now the purchase consideration of Arsenal and Man U is in 2 layers. Okay, the first layer, the first one is ordinary shares investment, which is the one that gives controlling interest. That's the only one that gives controlling interest. Okay, it gives controlling interest, and that is what we saw here as 220, if you remember. Now, we also have another investment, which is preference share investments. It doesn't give anything. This is key. This gives controlling interest. Okay, this doesn't give anything, but that is 60 here, which we also have here. And we are back at the 280. Therefore, let me take this down. We are back at the 280, which means we have been able to break down the 280 into the relevant section. Okay. Non-controlling interest also will be broken down in that slide. Sorry. Okay. Okay. I'll put it here, but there's nothing like this control. Okay, now I know of this. I can quickly bring that up. That's the one for preference shares. I've analyzed it, which is for others. See? Okay, the one that is left, which is unknown, this. I remember this is the one we need to do the proportionate share or the fair value for. Okay. And if I know what it is, I aggregate it. And once I know what it is, I can sum it up. I'll sum it up with, which means Arsenal on one hand, NCR on the other hand. And I'm still waiting for this unknown. Okay, the subsidiary's net assets, okay. The current amount of ordinary share capital, if you remember, is 250. Ordinary share capital of the subsidiary is 250. Now the pre-acquisition reserve, we've not dealt on that. As at acquisition, the retained earnings of subsidiary was 40, but at the reporting, it is 50. which means I'll come here. This is 40, while this is 50. And therefore, I have post-acquisition of 10. Therefore, I can come here and say, I pick this 40. Yeah? Now, if I sum this up, what I have without including the preference share capital is the equity attributable to ordinary shareholders, which means 290 is not the total equity, but rather it is the equity attributable to ordinary shareholders. Okay, because it's ordinary shareholders that benefit the entire of the retained earnings. Now, I need to bring in equity relating to preference share, which means I'll bring forward the preference share capital. 8% preference share capital, which is this 100 we have there. And until I put that, before I can have the sum of equity, which means this is now the entire equity. This is the total equity of Manchester United, which is to both ordinary shares and preference shares. Let me just put like this. OS means ordinary shares and PS means preference share. Therefore, this is total equity. Now, okay. And that is format. Okay. Now, whatever is left is our goodwill, if any. Okay. Now, in this case, what do? We need to determine this, which is unknown, and therefore come here. Remember, for ordinary shares portion of the equity, we can measure NCI as proportionate share of the identifiable net asset of subsidiary as at acquisition date, or we can do it at fair value. But here, there's no information about market price. Therefore, we are only restricted to this, which then means that if that is the case, I will recognize 30% of. I want somebody to answer 30% of what is going to be our NCI from the perspective of ordinary shares.
290.
Of how much?
290.
Why not 390?
Because 390 contain the element of preference shares, and we already know the element of preference shares, so the non-controlling interest.
Exactly.
So it's not part of it, yes.
Exactly. It's not going to be 290, okay? Because the 100 aspect has been delineated here, and we have separated them here into 60 and into 40. Therefore, we'll now say this is simply 290. Therefore, I'll come here and say 30% of 290 is 87. Therefore, I can come here, which is the equity ordinary share section that I'm looking for, which is 87. Okay? 87. Therefore, I can get an arrow which where it's coming from. Okay. That's where it's coming from. Therefore, what is my goodwill? My goodwill is the sum of these two. And that's 17. Okay, and that's how we carry it out in that manner, which makes more sense, which means the amount of NCI is now 127, which we'll bring out here and say NCI is now 127, no more 87, because it's both the element of ordinary shares and preference shares what we require. Okay, now, okay, or what I can do is that let me try and split it for better understanding. Okay, I'll split it so that if I'm not there, people can still be able to grab it, which means NCI at acquisition, I'll put this one to be ordinary shares. Equity. Okay, therefore I can leave it at that 87. Now I'll now come here, non-controlling interest stake in use, or let me just use subsidiary. Subsidiary is preference share capital. Remember, we have it there. That's this 40, which is also the 40 we have there. It's not a big deal. Okay, now in share of profits, it's only ordinary share that participate in it, and you're going to use the ratio of ordinary share 70-30, which means 30% of 10. 30% of 10. And I come here to say 30% of 10. Okay, and this will be 70% of 10. 70% of 10. Okay, whereas our retained earnings for the parent is 210. I come here. 210. Okay, that's 217. Now we don't need this section because we are not measuring NCI at fair value and we don't have information relating to it. And that's just all. You'll find out that this is where the job is for you to have an understanding of what we've done, even from this analysis we have here. Now, let me do the balance sheet, and from there, we have an understanding of what I want to also show you. Now, the PPE is 500 and 260. That's 500 plus 260. Goodwill is 17. Okay, current asset is 260 and 280. Okay, I have two forms of share capital there. Let me just, okay, ordinary share capital, snare loan, that's 600, 600. Also, we have preference share capital. It will still be a snare loan because we have cancelled out that of subsidiary, and that is also 100 incidentally. And our consolidated retained earnings is 217. I link that. Equity to SCI, both preference and ordinary share are lumped together and with the profit attribution. And we have that. Okay, current liability 130 and 140. And that's it. We're home and dry. Now, I'll show you something. The trick here. Let me show you. What if the investment we have in ordinary shares is 100? Which means if it's 100, it means what we have here is 100. What we have here is 100. And if what we have here is 100, it then means that if I'm to consolidate, I'm changing this figure, and if I change it, let me say my current liability is 170 here. Okay, which means for me to remodel the question, my current liability will have been 170, for example. And if that is the case, I come here and say it is 170. And you see that at the end of the day, NCI will only recognize ordinary share component. Subsidiary component will be nil. Conversely, if I come here and say parent as is 0, okay? If I say parent as is 0, it then means that in this case, this is 0. The entire component goes to NCI. Therefore, in that case, if it is 0, this will not have been 130, for example. Probably it will have been 70. And if it's 70, what will have been the balance sheet look like? You can see that the balance sheet will show that the entire non-controlling interest will have been attributed to the non-controlling what? Interest. Can you see? And that is what we tend to explain here, where it was being summarized from what you read there. And it's what was being summarized somewhere here in all of these readings here. Okay, and that is when you go to the opening chapter, you find this position here. The whole of this summary, the 3 possible scenarios are what I've demonstrated with respect to preference share capital. Okay, in that light, is there any question? To the contrary. Any question? Any question? Now let me return the figure to what it is, 130. Okay, and let me return this back to 60, which is the 60 we have here. Okay, and nothing's been equal. And that's just it. Any question? Okay. Therefore, we have been able to make justice to the principle of consolidating a subsidiary with the parent in a situation where the subsidiary has within its capital structure preference share capital. Okay, in the absence of none to the contrary, thank you very much. and God bless you. And in the next session, we will be looking at these aspects, okay? And we'll be looking at chapter 8, other principles in business combination, accounting, and group accounts. And we might be looking at some other key principles, okay? We'll be looking at application of uniform reporting dates, okay? Reporting dates, both reporting dates and accounting policy, the uniformity of them. And we'll likely also look at recognition of contingent liability in a business combination. All of these are what we're going to take into consideration in the next section. Okay, is there any question, any contribution, any remark before we call it a night?
There's
Any
actually no
question?
question. Yeah. So I just want to appreciate the class. Thank you very much, sir.
Okay, thank you very much. Okay, if there's no question from anyone or contribution or chat, therefore, we'll call it a day. Thank you very much, and God bless you guys.
Thank you, sir.
Thank you guys, too.
Thank you very much, sir.